So I want to bring up a topic that I believe we discussed quite a bit in our team meetings, and it's in regards to valuation. And this directly brings up the topic of growth versus value. Can you sort of bring the team's views to that ever so popular topic today?
Yeah, and so Akilan, you're probably going to get quite a long answer here, and I apologise because it's something that comes up a lot. And I suppose what we wanted to flag is obviously this is becoming quite prevalent in a post-COVID world. But there really are two things going on here. One is that the discount rate has collapsed to a very low rate, and on the one hand, this discount rate has collapsed, and on the other hand, you're seeing this pull forward of demand for digital businesses, but also for healthcare businesses and many growth or disruptive businesses around the world. And together, that's seeing valuations go higher. In the short term, as we said, that sort of makes sense to us. And in the longer term, the longer this goes on, you should probably expect that to continue happening. But if you actually look a bit longer out, this has actually been happening for quite some time. And this concept of growth versus value is I think, somewhat misunderstood. And we understand the growth companies get ahead of themselves sometime, but we think the core underlying thesis is misunderstood. And I think the core underlying thesis here is for most of the naysayers is fairly simple, is they would say that interest rates have fallen from 20% to 1%, i.e. the discount rate's gone down, and so these stocks have gone up a lot. And I always say to that argument, yeah, that's exactly true, because, Reed Hastings set up a DVD delivery service in California and turned it into Netflix in less than 15 years. And that only happened because interest rates fell from 20% to 1. Or that Jeff Bezos, set up a bookstore in his garage and in 20 years turned it into $1.6 trillion of market cap. And that only happened because interest rates went from 20% to basically zero. And so the answer is no, there's actually something else going on here. And there's clearly something else going on here, and there's something else that's been going on for some time. And the thing that we would point to, and we'd point to quite regularly, is this concept of Moore's Law. And so we're very lucky that we actually live in this time of digital transformation. I know we don't feel lucky today, but we are lucky that we do live in this time. And so what's been happening with Moore's Law, or what's been happening with technology for a very long period of time now, is computers has effectively got faster. The first semiconductor that Intel created in 1971 by Gordon Moore had roughly 2,000 transistors on it. But every 2 years that's doubled. And as that's continued to double, it's effectively turned into an exponential. And you now have the latest transistors in the markets, or the latest semiconductor setups in the market, the NVIDIA A100 by Jensen Huang, which has 54 billion transistors on it. And so as these computers get more powerful, disruption accelerates. And the simple way for people or the viewers to understand this is just think about what the internet is being able to do for you in your lifetime. It's gone from being able to send an email to being able to create a search engine, to effectively getting on your telephone, to ultimately streaming video, to ultimately allowing collaborative video games, and then finally moving into areas like software, etc., where we can create companies like Zoom, for instance, which is the latest disruptive company in the market. And so what we're saying is, as these computers get faster, disruption accelerates. And as disruption accelerates, more and more of these companies start appearing. So if you consider this acceleration of Moore's Law and this acceleration of disruption, if we then take that and look at what's been happening over the last 10 to 15 years, and we look at some of the bigger winners in the share market over that time frame, what we can see more and more consistently is these big companies that are using this technology. They're investing heavily in this R&D to drive sales growth. And these are effectively the big platform companies that we've talked about over and over and over here at Munro, whether that's Amazon or whether that's Alibaba. And they invest heavily in this R&D. They invest heavily knowing that this equation will improve for them over time and drive sales growth across that. And what's I think most interesting post the crisis is the number of companies that have been so-called shareholder friendly through this crisis and ultimately bought back stock or paid dividends and not invested in their company are not actually being rewarded by the market. And so if you assume everything I just said there, Akilan, is correct, and we roll this forward to the next 10 years, then it becomes abundantly apparent to us that the way that companies win in the future is to spend money. The way that companies win in the future is to spend on their businesses, to grow their businesses, to become one of these very few winners that we've seen over the last decade. And if we actually go back over the last decade, if we look at it from the peak in 2007 to the peak in 2020, so peak to peak, and we look at the 66 companies over that time frame in the US S&P 500 that went up more than 10 times in value, a vast majority of them have revenue growth in excess of 10% per annum. In fact, many of them have revenue growth in excess of 20% per annum. And on top of that, many of them have PE multiples that are well above 20 to 30 times, and in many cases are losing money. And so if you take everything I've said as true, then it's abundantly clear to us as we look forward that if your job as an equity investor is to find these very few winners, your job as an equity investor is to find these companies and invest them over the time, and particularly as a growth investor. And so inevitably we have to take a much longer term view than a short term multiple is going to give us. That's what has rewarded us for the last 10 years, and we see nothing in the trends going forward that will suggest that this scenario will change. If anything, it's likely to get worse. And so while I know the growth versus value discussion focuses very much on near-term multiples, I would just finally conclude by saying that focusing on near-term multiples is not going to help you here in the long run. And ultimately, if you are looking at a near-term multiple, you are effectively just taking a shortcut. You are being somewhat lazy in your analysis. And so the last thing we'd say is that we're not actually saying we are not value investors. We are value investors. We do think these companies are cheap. We're just taking a much longer term view about how the world will change and how these companies could win over that time frame. And are they doing the right things to invest to win over that time frame? Because it's abundantly clear to us that the companies that do invest are the ones that win in the long run. And I apologize, Akilan, it was the long answer I threatened it would be.